here's like a basic power law model that models the average of Bitcoin over its history. We've discussed this a long time. This is one of the best models if you are interested in predicting, just modeling the average behavior or the pattern of Bitcoin. If you've been following us, we've been talking for the last few weeks. When we were below the power law line, we were saying this line is constantly growing and the price cannot stay below it for too long. Sure enough, it caught up and it has surpassed it. And we kind of think of this average value as the anchor. And when we enter the bubble phase of the bull market, we will go above it. We will go a lot above it. But after the peak, we will come back to it. That has been at least a historical pattern. Now, this is a closer look, 92 versus 81. You can analyze that gap and turn that into an index, which I've done here. And the index shows we are, even at 92, we are still at a neutral valuation. The top of the cycle is far from where we are. And this is great assurance if somebody is wondering that, if there's a bubble that's about to burst, nothing is impossible, but this model shows it's not very likely. We are actually very close to what the historical pattern would take us to. Here's a model, Bitcoin power law probability model that PlanC has been working on a lot. Do you want to cover this one?
Yeah, I'll cover it quickly here. So this one, you guys will be familiar with if you've been watching for a couple weeks here. So with this one, a lot has changed actually, because we haven't covered this in a couple weeks. So there is actually significant changes, of course, with the price action. So with this one, it's showing the percentiles, right? So essentially, we've moved up. The fair value is the 50th percentile. Like the fair value, you can see that's the gray kind of dash line. That's 70,825. So fair value is around 70, 71 with this model. And that's 50% of the data points above, 50% of the data points below. And then the current price, I just generated this, so it's 92K. And that puts us 30% above fair value, right? So 30% above fair value does not mean you should sell your Bitcoin. Let me be very clear. 30% above value does not mean you should sell your Bitcoin. During the bull run, we go well above fair value, right? So all it means is it's just a way of showing that it's just basically the model, right? So we're at the 65th percentile, right? Out of the full data set, the full probability distribution with the power law. So we're at 65 percentile, right? And the orange starts at 90. So 90 to 97 is the orange, and then 97 to 99.99 would be the red. So those are the top two bands. The bottom band, that's the 0.1 percentile to the 5th percentile. So the bottom 5% of the data is the blue. The top 10% of the data is the orange and the red. And right now we're sitting basically 2/3, right? We're at the 65th percentile. So 30% above fair value. We've made a huge move, but we still have lots of room to go up. And this changes every day, right? This is only based on today. This is the distribution today. And then it's going to continually increase over the next year. So that doesn't mean that this is predicting the peak is going to be 288,000. If we were to get to 288,000 today, we'd be at the very highest part of the distribution, and it would be a high probability that we'd need to go back to closer to the mean, right, or the median. So we're nowhere near 288. We're sitting obviously at 92. So we're in a healthy range. We are getting higher up in the distribution. That's basically all this is showing. And it's going to be an interesting one to track over time as we get higher and higher up here. I do think there's a really good chance we do get to the 90th or higher. There's no guarantee we go to the red. There's obviously no guarantee we even go to the orange, but it's looking more and more probable that we do make it at least to the orange, if not to the red, this cycle. And it's going to be interesting to track. I don't know if you guys want to add anything to this.
No, I think it's pretty clear, very, very interesting. And something I'll mention is the quantile model that I'll also discuss has pretty much the same number, right? I ended at 285, you ended at 288, and you and I have had like zero coordination. So we are completely independently doing this and arriving at the same values.
Yeah, and this I'm using 10-minute data. You're using, I think, daily data, so it's going to be very, very similar. There's not really a big difference between 10-minute and daily. It just allows me to update it throughout the day. That's all. But the actual, like when you average it all out, it's essentially ends up being pretty much the same stuff. So,
but your percentiles are wider. You go to 90.
I'm using the 99.99, so I'm giving like the full distribution. Like, I mean, that top, I think you go to 99 percentile. I'm pretty sure on yours. But yeah, there's going to be some small differences there, but it's essentially a very similar distribution.
Okay, and then there has been a few questions about the fair value here. The median is defined as fair value, and it's basically a number where you can expect half of the time we're above, half of the time we're below. So if that to you is a reasonable base, we use the fair value concept for that.
Yeah, the reason why are they asking the reason why there's a difference between our models? So your last one you showed has, I think, the fair value at like 78 or something, or 80,000. That's because you're using a mean fair value. This is a median, right? So yours is based on basically the average of the data set, whereas mine's based on a median. So it's very similar, but one is, like you said, 50%. This is 50% of the data points above or below, and yours is based on like an average of all the data points. So what happens is the peaks, we've covered this before, I'll just be brief. The peaks are so extreme that they pull up the average when you do an average, right? Whereas with this, it's more makes it so it doesn't pull up the average because you're treating all the data points kind of more similar. So that's the reason why there's a difference there. There's just two different ways of looking at the fair value. That's all.
Yeah. That was a good explanation. Yep.
Someone is saying all models are going to get broken. I hope it gets broken to the upside, but when you model data, if you have done your job correctly, that's the base case, right? So and all of these models assume historical patterns continue. So if historical pattern continues, this is what we will see. But it's not impossible for Bitcoin to suddenly change trajectory and do something completely different. We are open-minded, but with the information we have today, that's the best we can predict. If you think it's too low and you want a lot more, just go back to last cycle and remember when people were promising 500K and there was this debate going on in 2021. If you said my prediction is if my prediction is PlanC, Plan B is 288, people would say you're crazy bearish, and 500,000 appeared still bearish, and people were thinking about 1 million. Reality was a little bit different at 65K. So, and then that's exactly what this model would have predicted. So there might be something to this model. That's all I'm trying.
Yeah, Sina, you had a great out of sample prediction chart like a month or two ago. I thought we should bring that back, because I think one thing when people make the criticism kind of generically saying all models will break, I mean, not all models, I mean, all models will have some uncertainty, that's for sure. But I challenge people who hear that mantra, right, and go and investigate this for yourself. Like, you can go back. I would challenge anybody to try to take any of Plan B's models from the last cycle, the last go around. Try to replicate that yourself with all the different versions. And Sina, you've covered this pretty extensively, but try to take all of his different versions and try to throw the data since he put those models out up to today. See how any of those models play out, if you're even able to get it to be replicated. Versus what we're playing around with here. It's a very simple model, actually. Like there's two parameters. It's called the power law. And if anybody is curious for themselves, they can go in and verify it. The nice thing is they can actually go in and verify themselves now. It's not too difficult. And so if you want to reach out to any of us, I mean, at least speaking for myself, we're happy to sort of walk through how you can replicate this very simple model and show its reliability. So trust, don't verify, I think, was what I like about this power law model.
No, verify, don't trust.
And
sorry, I had it backwards. Verify, don't trust. Sorry.
Just sorry, guys. Very, very briefly. I'll be super brief with this summary. This is just for anyone, again, because if someone missed last week's show, I can summarize this in just really briefly in a couple minutes here. So to do a stock to flow, just to put it to bed, what happened with stock to flow is Plan B basically created 3 models. So what he did is he created one model where the last cycle, the average price was 50,000, one model where the average price was 100,000, and one model where the average price last cycle, and when I say cycle, it's the halvening to the next halvening, right? So one was 50, one was 100, and one was 288. What has happened is 2 out of those 3 models have kind of failed, right? So he basically bounced around between 3 models. Technically, from what people have told me, the first one he created was the 50K, and he's reverted back to that. But just so people understand, he had 3 different models that went all the way from 50 to 288 as the average price for the last halvening to halvening. And he's basically 2 out of 3 have now failed, and he's reverting back to the third. So when you have 3 models and you have a huge, it's a lot easier to be correct when you have 3 models and you can jump between them. And the power law had one model generated at the same time, and the power law model was more accurate than all 3 of Plan B's models. So the power law was accurate within 5%. The average price between the last 2 halvenings was around 33,000, I think. I could be off on that, but it was around 33. The power law was within like 1,500, so it was within 5%. And obviously, Plan B's model was 50K, and it was over 50% higher than that. So that's the summary. He created 3 models, giving himself the ability to jump between them. 2 of them out of the 3 have failed. One's holding on for dear life. The power law, there was 1 model created, and it was more accurate than all 3 of the stock to flows. So the power law has never changed. It's been a more useful model, and it's been very accurate. And when you look at it from an average price between the halvenings. So we can move on to other things, though.
Perfect. Yeah, thanks, PlanC.
Very good. Okay, so next, it's a different model, quantile model, kind of a different way to show the same analysis that PlanC discussed. But the only difference I have here is I realize that we can get some useful insight if we break down the whole range that we were talking about into 3 regions. And it seems like, first of all, because these regions are based on quantiles, they actually define the periods, the regions where Bitcoin spends 1/3 of its time. So the blue region, Bitcoin will spend 1/3 of its days in there, green region 1/3, red region 1/3, and these are bubble phases. And then there is 2 small run-ups and run-downs from red to blue that forms the green region, and then we drop to the bear market phase. So where we are is actually pretty interestingly right on the boundary, and we have actually tried to cross this boundary twice so far. We moved above it, then back down. Today we moved above 294, and then right now we are at 292, if it hasn't changed since the beginning of the show. So it seems like transition to the next phase is taking some more effort, but we definitely appear to be ready for that. And if you look at the history, if I just go back, typically when we spend a long time, as you can see, like 1/3 of the whole time in the blue region, but green is rather fast. And pretty much what we have done here, green is like is a takeoff zone where we warm up and we rapidly cross it at when the market is ready, and we get into the bubble phase, the crazy price action of the red. So I'm excited for us to get there. We are right on the boundary. And again, this is another way to show where we are in the cycle, or at least the range of possibilities, right? So you can see we are now at 66 quantile, and there is another 1/3 of the cycle that's left, which is going to be the most exciting and most rapidly changing part. This is another like linear view of it, the same thing. Here, I'm just trying to show that we've had a bunch of bounces off this level. I don't know why exactly we're doing this, but these lines have been created a long time ago, and somehow prices stuck right on it several months later. Sounds an interesting pattern to me, but I don't have a great explanation why this is happening. The other thing I'll say is this quantile model from the get-go, it was extremely exciting to me because it gives us probabilities. It's not TA, it's not just connecting lines. It is a model that actually gives you probabilities. And why do you care about probabilities? First of all, it gives you a much better expectation. For example, this model is telling me that if the pattern continues, that's a huge if that a lot of people try kind of miss or ignore. But in the end of 2025, this range will be 55 and 285. So this is the range of values I'm expecting. In the horrible case, if we go back to a bear market, this is it, 55. If we get to the absolute top, that's 285. Again, sorry for more aggressive bulls. This is 99% likelihood. So it doesn't say it's impossible for us to go above it. It just says it's less likely, a lot less likely.
Oh, one thing, sorry, Sina, to interrupt, but one thing worth noting. So you said mine was 288 and this is 285, but mine was based on today, right? Because it's all the way up to 99.99. This is 99, but this is based on the end of next year, right? So the interesting thing is that last percent, you can see how the distribution of the data points.
Oh, okay.
So they're actually not the same, like because yours is extended out to the end of next year. I haven't showed the extension of mine. So there's actually quite a difference if you go to the 99 or the 99.99. You wouldn't think that last percent makes that much of a difference, but it just shows you how extreme Bitcoin gets and how the data points in that last 1% of the distribution are so far away, right? So that might be confusing people, but
yeah. So let me explain what's going on. If you think of a distribution like this, okay, I'm cutting it at 99 percentile. Maybe I should use better colors here. Let me find, is that, okay. I'm using the 99th percentile and the first percentile. But if you've looked at normal distribution, this isn't normal. This is probably log normal or Weibull or something like that. But these distributions never end. So actually there's a very long tail on either side. But the point is, it just gets a very small probability. Now, just because PlanC is cutting it off at 99.9, he gets a much higher price. But it's basically the same math, right? So it's just a matter of what part of the distribution you want to consider kind of unlikely.
Yeah, the interesting thing that's a good way of saying it. The interesting thing to note about that is the 99, the line that you're using. We hit that line in all three of the last three cycles. So we reached the 99 percentile in the last three cycles. Whereas with my 99.99, we reached that in 2013 and 2017, but we didn't reach that the last cycle. So that's the difference between the two lines. Is the line that I'm using, I'm basing it on kind of the line that we reached in 2013 and 2017. I included it because we have reached there in 2 out of the last 3 peaks. But with your line, we reached in all 3 of the last 3 peaks. So that's the difference.
Yeah. So you're trying to ensure that you cover all the even more bullish cases. I'm trying to be a little bit more conservative.
Yeah, essentially. Exactly.
Anyway, so moving on. This is where I was going. A model like this gives you a base case probability. Again, probability is a very bold claim if you want to predict the whole distribution of something.
I agree. Yeah, but still,
careful with it. But at least it gives me a nice baseline. So this is kind of an extraction. What did I do? This is an extraction of probability that model predicts. And I just arbitrarily for now, just for display, I've set it at September next year. And this model would say 99% would fall at 258 and then 1% 51. So this is actually getting very interesting with all the IBIT options that just got approved today. And if you want to analyze any option, you would know that you need to have a guess about the probabilities of different outcomes in the future. So having a base case like this at least gives you a starting point where you can say, okay, if I'm trying to buy an option next year and there's a huge range of values possible, what strike price is good? And then you can use probabilities like this to give you the right risk reward. For example, this would say that 150 is kind of, to me, it sounds like a no-brainer. Like by sometime next year, getting to 150 is very achievable, very much. And you can see it's kind of leaves at about 30% chance that we actually go above that as well. But if you increase your strike price to 200, you see that you're covering 90% of the distribution. So there's still quite a bit of chance that we go further than that. But I wouldn't go near the 254. I want to give myself more chance than 1%. So this is a wonderful guide for an analysis like that. And we don't have any other model that I'm aware of that gives you a prediction of probabilities. That's a testament to the fact that this is an extremely difficult task, and that's why I'm just repeatedly saying this is a base case. Not, you shouldn't really bet heavily on it. If I was myself, I would just add a 30% gap cushion to all the numbers that comes out of models like this.
I just have one quick question, Sina. So I just want to understand this fully, and I think I do, but I just want to make sure, and also help the audience. So this distribution, though, is based on an equal weighting of It's basically saying that we could be anywhere in this distribution at any point in time. So it's timing agnostic, right? So people understand, next year, we would expect next year to be bullish. We don't know for sure, obviously, but all indications are that next year we should most likely be towards the higher end of this distribution, right? So, but this isn't factoring in whether we're in a bear market or a bull market. This is just saying this is the equal probability that we could be anywhere at any point in time, correct?
Yeah. So the best way to think about it is as a channel, because like this, right? So this channel captures 98% of the data, and the way you did it, almost 99.8% of the data. So, but what part of the channel we will be at any point in time, that's not covered by this model. For that, you can use your own judgment. Do you feel like next year is going to be really bullish, or are we about to go back to bear market? My bets will be that next year is going to be even better than this year, with all the interesting things that are happening. So this model doesn't give you the timing of the peak. It gives you the range over time. But within that range, which part of it you'll be at least this model doesn't comment on that.
But you can essentially adjust those probabilities, because those probabilities are saying that it's not factoring in if we're in a bear or bull market. Like if you go back to the last chart you were showing, right?
Which one?
Sorry, the probability distribution. Yeah. So this is not factoring in that we're in a bull market. So if we're in a bull market, I would say I would probably adjust these a little bit to say, okay, if I think we're going to be in a bull market next year, I would increase the probability of the ones that are above 50%, say, or something like that, right? You could.
Oh, that's a very nice bit. I mean, I always say you look at things in a very interesting way and you prove it all the time. Very good way to put it. It's extremely difficult to kind of simplify this. Yeah, but you're absolutely right. Our median 88 here applies to the whole cycle, right? But if you're looking at bull market, numbers will completely differ. As we've seen here, bull market actually, the most important part of the bull market is the red region, where we are above 66 and 99. So if you're actually interested in the FOMO region, the numbers that apply to you is anything from 130 here to the end of the region, 254. So this model definitely needs to be improved by a more intelligent analysis of the cycle portion that we are in. So this is
this is like a
you could almost make a model just assuming we're in a bull market and basically sorry, go ahead, Sina, I interrupted you, or Svensson, you go ahead.
Oh no, I was just I didn't mean to interrupt. First of all, I'm very partial to sort of the cross-sectional look that you were kind of trying to draw on the time series price chart, which is also a great view. But this to me is like you're basically plotting the distribution of sort of the price deviations, I believe, right? Sort of translated into probability masses. And so I think everything ideally sort of here adds up to around 100%-ish. But the reason I like this so much is that it's taking percentiles, as you guys were talking about, kind of being agnostic to the hills and valleys along the way. And so I think that this is, now that I'm thinking about it, it's especially useful as you look far out into the future, where you're a little bit less certain as to where we might be going up a hill or down a hill, which very much could be the case end of 2025, 2026, 2027. This thing is going to be a very useful, if people take the short learning curve that it would take to understand this type of chart. It really could pay off, because your mean is going to be closer to the true mean. The median is going to be closer to the true median. So anyway, yeah, kudos to the nice chart here. I think this is great.
And this really is basic. And this is basically saying, this is another way to look at this, is it's how much time we spend. These are almost like buckets of time. And it's like, how much time do we spend in each price range? So it also shows you that we spend the vast majority of the time at the lower percentiles, right? So it shows you, it's called a right skew is what this is technically called. But essentially it's showing you that the further we get away from the mean, the less amount of time we've spent there historically. And that's just the way Bitcoin operates. And that's just the way these exponential blow off peaks are. And then you very quickly come back. You can almost feel the energy increasing, and the speed of everything seems to be, because we were just like lulled to sleep for a couple of years, right? Underneath the 50th percentile, just kind of, we're in the very low part of the data set, just kind of hanging out. And that's those first few bars there, right? You can see those bars are the biggest. That's where we spend the most amount of time. And then as you go up the data set, you spend less time there. So it's just something for people to understand that, don't expect to be at these very extreme high parts of the data set, like above 80th percentile, 90th percentile and higher for very long, because that's just the way things usually are, right? I mean, doesn't guarantee it's going to play out that way this time, but that's really how the data set has worked historically. So anyways.
Yeah. And again, when you analyze data, you kind of have all the caveats in your head, but it's important to make sure everyone else understands it. Anyone who tries to model the future, first of all, they should really know what they're doing. I'm not saying we are, experts or anything, but my point is, you have to be, as the audience, you have to be a little bit more skeptical. So you have to understand what kind of assumptions you're putting in there, or maybe ask the analyst to tell you what are the assumptions. So one of the biggest assumptions here is we are expecting the past pattern to continue. We've done our best, lots of analysis that gives us a lot of confidence about the fact that we have gotten the pattern right. And a lot of the cross-validation analysis that we've done before shows that at least for the past 8 years, the model has been robust and captures the systematic pattern that has existed in the data since day one. But the pattern, there is a likelihood that it changes, but it's actually not a high likelihood in my mind, because a pattern that has persisted for 15 years would take a massive, massive, massive change to break. So at least for the near term, and by that I mean in the next couple of years, it's not very likely that such a macro pattern will change. But you just have to keep in mind that everything we discuss is based on that.
Yeah, and it's actually multiple patterns would have to shift. One is the volatility, because and Sina, maybe you can go to your you already went through your volatility adjusted, I think. Did you go through the volatility adjusted already? I'm blanking.
I showed the...
Did you show the volatility adjusted power law?
Yeah, yes. But I didn't really explain, how this is created. Yeah.
Right, because one of the patterns is like a decreasing in volatility since the very beginning, and that's how you created this model, is you're adjusting for volatility. So that volatility pattern, where volatility has been decreasing since the beginning of Bitcoin, that pattern would have to break, and the power law pattern would also have to break. Both patterns would kind of have to break for us to just shoot up through the ceiling of the power law, the models we're showing. Essentially, you'd have to have everything completely shift overnight.